Thanks for clicking. The Canadian economy may no longer be able to rely on China to keep our prices low. This was one of the main messages coming from Bank of Canada Governor Tiff Macklem during his final speech of 2022 on Monday. Indeed, we've been tracking China's domestic developments on this channel for a little over a year now, taking a look at how those developments would impact Canada's economy. But as of late, we're seeing signs of an increasingly strained relationship between Canada and Beijing, with Canada and the West in general growing gradually more wary, gradually more vocal about our continual reliance on China to produce our goods.
To tread lightly.
But Governor Macklem's speech put Canada's relationship with China in the context of our monetary policy and our 2% inflation target at the forefront, a context which looks like it's going to be increasingly important in 2023 and beyond. So what I want to do today is go over Governor Macklem's speech and what he had to say about China, especially in the context of Canada's 2% inflation rate target, discuss what that means for Canada's economy going forward, and then take a look at what to look for next. This will be our last China update for 2023, as I'm going on holidays late next week and won't be back for 2 weeks. However, we will continue to track China's development in 2023 on this channel, especially as it relates to Canada's economy. Click like and subscribe if you want to get those updates, but for now, let's get into the speech. During his final speech for 2022, Governor Macklem pointed directly to China for its role in keeping Canadian inflation low for the past 20 years.
The entry into the global trade system of vast new labor markets in China and Eastern Europe pushed down the prices for many goods.
Indeed, while Canada imported only about $5 billion worth of goods from China 20 years ago, as of last year it imported $68 billion, a major increase. This increased trade with China, the increased reliance on cheap labor coming from China to produce our goods, helped to keep Canada's inflation rate low for the last 20 years, which in turn helped to keep our interest rates low for the past 20 years.
These supply developments all fostered a period of solid growth, low inflation, and low interest rates.
Canada's reliance on Chinese labor, on cheap Chinese labor to produce our goods, was amply demonstrated during the high inflation caused, at least in part, by broken or stalled supply chains emanating from China throughout the pandemic. But this dynamic, where China produces our goods on the cheap and we get a low inflation rate and low interest rates, may not be the case for much longer, according to Tiff Macklem's speech.
In the future, it seems likely that supply chains will be shorter, more diversified, and more resilient. Trade will likely narrow to more trusted partners.
Yeah, shorter, more resilient supply chains, that means not China. Trusted trading partners, that definitely means not China. And here's where we get to the main thrust, the 2% inflation target.
Over the long term, it seems likely that we won't have the same disinflationary forces that we've had for the last 30 years. These potential developments could make it harder to bring inflation back to 2% and keep it there.
So what Governor Macklem is saying is that 2% inflation target, the inflation target that we've had for the past 20, 30 years, may no longer be attainable, especially if tensions with China continue to get worse.
They will. They definitely will.
But if that's the case, as Governor Macklem says, if the US, if Canada, if the entire West is no longer relying on China to produce our goods cheaply, which in turn keeps our inflation rate low, if that is in fact the case, then that leaves us with two very unattractive options going forward. The first is to raise that inflation target, raise the inflation target above 2%.
Oh, you.
Fair enough, but we're already seeing murmurings of that in the press, with some beginning to argue that a 2% inflation target is arbitrary and could in fact be raised. If you change the goal to suit your current position, then your current position isn't so much of a problem. On the other hand, the other option would be to raise interest rates continually higher.
Oh,
Again, yeah, fair enough, but the idea would be to suppress demand to such an extent that it would make up for the higher cost of goods that aren't coming from China. But neither option, changing the inflation target, allowing inflation to go higher, or raising rates, causing more pain, is very palatable. But if what Governor Macklem is saying is true,
doubt it,
that the West will no longer be able to rely on China as much to produce those low-cost items to keep our inflation rate low, then the central banks are going to be faced with one of those two options. Either raise the target inflation rate higher than 2%, or raise interest rates to get us back down to that 2%.
You get one way or the other.
And while this decoupling from China, this decreased reliance on the production of our goods coming from China won't happen overnight, I would expect to see more and more discussions of this increase in the target rate going into 2023 and into 2024, maybe 2025. Like I said, this isn't going to happen overnight, but this is a very different geopolitical context than we've had for the past 20 years. But as the low inflation and low interest rates of the past 20 years have shown, the geopolitical context matters. And if that geopolitical context changes, then I think it's reasonable to assume that our central banks are going to re-examine their policies along with it. With that said, Canada's relationship with China will no doubt continue to have a big impact on our economy throughout 2023, and as such, we'll continue to follow it all next year. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.